In trading, the market doesn't move in a straight line. Instead, it moves in waves. This is where the concept of impulse and correction comes in. An impulse is a strong directional move, typically driven by volume, volatility, and trader conviction. In this chart, the first green arrow labeled impulse shows a powerful upward move. This suggests buyers were in control, pushing the price higher. After this, we see a correction, a smaller pullback against the trend. This correction is natural and healthy, allowing the market to breathe and set up for the next move. The second green arrow shows another impulse move, continuing the upward trend. This confirms that the market is in a bullish structure, higher highs and higher lows. Again, a correction follows. It's crucial to understand that corrections do not mean a trend reversal. They are pauses. During corrections, professional traders look for re-entry opportunities to ride the next impulse wave. Now observe the final impulse move in this uptrend. It's steep and aggressive. But look closely at the correction that follows. It's shallow and slow. This could be a warning sign. When corrections become weak, it often means the buyers are losing strength. The trend line is still holding, but pressure is building. Here's where things change. The trend line is broken and the price closes below it. This is a classic breakout of the bullish structure. It signals a shift in momentum. Many traders get trapped here, still expecting the price to rise, but smart money has already exited. The breakout is the first technical confirmation that the market might reverse. After the breakout, we see a clear reversal. Price starts to form lower highs and lower lows, indicating a bearish trend. This reversal is powerful. Notice how steep and consistent the move down is. It confirms that the previous bullish trend is over. The market structure has shifted from accumulation to distribution. This chart is a perfect example of the market cycle. Impulse correction continuation, final impulse, weak correction, breakout reversal. It teaches us to respect trend lines, recognize when momentum weakens, and never ignore a breakout against the main trend. Reversals don't come suddenly, they give signs. You just have to learn to read them. After the initial breakout in the previous chart, this one starts with a powerful rally, continuing the upward momentum. A rally is a sustained upward movement driven by aggressive buying. Here, the price moves in a clear uptrend, forming higher highs and higher lows, which indicates bullish sentiment is still dominating. This phase attracts retail traders, thinking the trend will continue forever, but institutions are preparing for the next stage. Suddenly, the price stalls and enters into a range. Ranges are periods of indecision, where neither buyers nor sellers have control. These zones often signal accumulation or distribution by big players. In this case, it seems like distribution, as the price struggles to break higher. This is a classic sign that momentum is weakening. Smart traders watch these zones closely, as they often lead to explosive breakouts or breakdowns. After ranging for a while, price breaks out upward again into a second rally. But here's the trap. This rally is less steep than the first, and volatility decreases. This is often a bull trap, where buyers are lured in again, thinking the trend is resuming. However, behind the scenes, institutions are unloading positions. The rally lacks strength and fails to create new, strong highs. Next, the market enters a second and much larger range. This is where the smart money exits. Price bounces up and down in a sideways structure, confusing retail traders. But if you observe volume and price action, you'll notice buyers are exhausted. This is the textbook phase of distribution before a downtrend. Once again, the market gives us a clue that a major move is coming, then comes the sell-off. This is where the big players finally pull the trigger. The price crashes, forming lower lows and lower highs, confirming the beginning of a bearish trend. This phase is fast and aggressive. Retail traders who were stuck in the previous range are now forced to sell at a loss. Panic selling fuels the momentum further, and the market drops rapidly. This is not a correction, it's a full trend reversal. His chart shows the evolution of market sentiment. Rallies represent greed and optimism. Ranges show indecision and professional positioning. Sell-offs reflect fear and loss of confidence. Understanding this sequence helps traders avoid emotional decisions and stay aligned with market structure. Always remember, the market speaks through its structure, not through indicators. The market doesn't move randomly. Every chart, whether in Forex, stocks, or crypto, goes through 4 key market phases: accumulation, advancing, distribution, and declining. These phases are shaped by professional traders, institutions, who enter and exit the market strategically. This visual by Trading with Rayner simplifies what every trader must master to win consistently. Let's break down each phase. The accumulation phase occurs after a downtrend ends. Price movement becomes flat, volume dries up, and volatility shrinks. But make no mistake, this is where smart money starts buying. Retail traders usually ignore this phase, thinking the asset is dead. But professional traders are silently building their positions here. The 200 EMA begins to flatten, a sign the bearish pressure is fading. This phase sets the foundation for the next rally. Tip: learn to spot consolidation near lows with EMAs flattening. That's the footprint of institutions getting in early. Once accumulation ends, we enter the advancing phase, a sustained uptrend. This is where the markup begins. Price consistently makes higher highs and higher lows. The 200 EMA turns upward, confirming the trend. Volume increases, and more traders start noticing. Retail investors begin entering as the media talks about the new bull market. This phase is where you want to ride the trend, not fight it. Use trend-following tools like pullback entries, moving average bounces, or Fibonacci retracements. This is the easiest money-making phase if you follow structure. After a long uptrend, price enters the distribution phase. It moves sideways near the top, volume becomes unstable, and the 200 EMA flattens again. This phase is tricky because price doesn't fall right away. But inside this range, institutions are offloading their positions slowly, without triggering panic. Traders must be cautious. Buying in this phase is risky. Many traders mistake this for a continuation, but the energy is already dying. Indicators may show divergence, and range trading strategies work better than breakout trades here. Finally, the market enters the declining phase. This is the markdown, and it's violent. Price breaks down from the distribution range, and sellers dominate. Lower highs and lower lows confirm the downtrend. The 200 EMA starts to slope downward again, showing strong bearish pressure. This is when retail traders finally panic and sell their positions, often at a loss. This is not the time to buy dips. The market is in a full-blown downtrend. If you're not already short, stay out or wait for the next accumulation phase. Protect your capital. Each of these 4 phases is driven by emotion, accumulation, fear and disbelief. Advancing, confidence and euphoria. Distribution, greed and hope. Declining, panic and regret. Smart traders don't follow emotion, they follow structure and volume. Understanding where you are in this cycle helps you position yourself smartly and avoid chasing hype or panic selling. Now let's connect the dots. The impulses and rallies in the earlier charts occurred during the advancing phase. The corrections and ranges are part of accumulation and distribution. The breakout and sell-off represent the declining phase. So you're not just seeing separate setups, you're witnessing the full market cycle. This understanding separates professional traders from amateurs. So what have we learned? Markets move in a predictable rhythm, not random chaos. If you can identify whether the market is accumulating, advancing, distributing, or declining, you will always trade on the right side. Every phase is a message from the market. Your job is to read it. If you found this breakdown powerful, like, subscribe, and comment "Smart Money" below. This is Financial Freedom FX, where we decode price action like professionals.